Good morning, everyone, and good afternoon for those who are joining us overseas today for another presentation in our Burgiss Applied Research webinar series. My name is Chris Swanson. I'm one of the senior sales executives here at Burgiss. Today's topic is titled Constructing a Benchmark, the Good, the Ugly, and the Bad. We feel it's quite timely here at Burgiss given the volatility we're seeing across asset classes in the markets and the amount of questions and discussions with LPs we've been having around best practices for benchmarking their increasingly growing private capital portfolios. Today's presentation will be led by Luis O'Shea, who is the head of applied research here at Burgiss. For those of you who do not know Luis, a brief introduction. Luis joined Burgiss in 2017 as head of the applied research team. He has over 15 years of experience in quantitative research and finance and holds a PhD in mathematics from Cornell. Today's presentation will be approximately 45 minutes in length, with time allotted for a Q&A at the end. You can submit questions anytime during the presentation by using the question pane in the GoToWebinar panel on your screen. With that said, now I'd like to turn it over to Luis.
Thank you, Chris. So the genesis of this talk was essentially two things. So the first, as Chris mentioned, was that we received many questions from our clients about constructing benchmarks. But the second, and some of those, we've seen a variety of different approaches, and some of those approaches, we felt were better than others. But the interesting thing is that the second thing that sort of generated this webinar is that we began to realize that amongst those approaches, what made one approach better than another was not just a matter of opinion, but that there were actual quantitative perspectives on it that could sort of more or less settle the matter. And we felt that these are things that, deserved a wider audience. So hence this talk. Okay, so the outline of the webinar is as follows. The webinar, as I mentioned, is focused on methodologies for benchmarking private capital. So as such, it's fairly quantitative in sort of topic. Now, this idea has at least two different sort of levels that it could be looked at. One is the portfolio level. So this is where you're, of course, benchmarking the portfolio as a whole. And here we're going to describe first what we consider to be sort of the best or the methodology that we would recommend. And then we're also going to contrast it with a few other methodologies, some of which will be essentially approximations to what we consider to be the best approach, and some of which are, in our view, a little bit more problematic. And then next, we're going to turn to the fund level question. We're going to illustrate the shortcomings of the popular IRR rank-based benchmarking approach. And then in particular, we're going to show how portfolio ranks can improve some of those problems. And then finally, we're going to talk about how we can generate a report that combines all of the information at the portfolio and the fund level into a sort of best practices report that we think is pretty useful. Okay, so before I get started with these various topics, I think it's worth kind of setting the scene by saying what I mean by benchmarking. So the perspective I'm going to take is that what has already happened is that we've decided that a certain amount of capital is going to be, in fact, invested in private capital. So in a sense, what I'm saying is that an allocation or a strategic allocation has already occurred, and that's not really the purpose of what we're not going to be revisiting that in our discussion here. So then, given that, the question we want to answer is, how well are we investing our private capital, quite simply? So in view of that question, we feel that the right kind of benchmark, if that's the question you're asking, is what you could call a peer benchmark. So what I mean by that is a benchmark that is constructed out of a representative set of private capital funds. In contrast, of course, to maybe a public benchmark or a CPI-based benchmark. So, and one last thing is that although that is the focus that I'm taking in this talk, certainly sort of the right way and how to construct a benchmark is also relevant, for example, to strategic allocation and so on. But to stay focused, that's the question that I'm going to be concentrating on. So then, as I said before, there are sort of broadly at least two types of benchmarking that we can talk about. So the portfolio level question is trying to answer how good is our portfolio performance compared to a representative but skill-less portfolio. So again, kind of the sort of thing where in the public markets you'd expect to use an index or a combination of indices or something of that sort. And then the second question, the fund level question, is simply saying how good was each individual fund choice? Okay, so let's start with portfolio benchmarking. So since I'll be talking about portfolios, I thought I should at least illustrate exactly what I mean. And quite simply, it's something like what's on this slide. In other words, it's a collection of commitments to a variety of different private capital funds. So for example, in this case, it's a dozen commitments. The commitments span a number of different what we would call subclasses, namely buyout, real estate, venture capital. They span a number of different vintages, in this case 2010 to 2014. Each commitment has a commitment amount, which in this case happens to be exactly equal across every commitment, but could vary. And then in this one, we happen to have committed to one fund per vintage, but that could also vary. You could absolutely have a portfolio with multiple commitments in one vintage and zero commitments in some other vintage. Okay, so given such a portfolio, then what we want to do is we want to develop a suitable benchmark for that portfolio. So there are a number of different methodologies for doing this, and we'll be talking essentially about the leftmost three, the sort of green to yellow on this slide. And bear in mind that in no sense does that really exhaust all the different approaches that we've seen, and there's quite a few others that I think are interesting in their own right, but we're not going to cover. Okay, so let's start with what we consider to be the best approach, the recommended approach, and we're going to call this the portfolio based methodology. So the idea behind this is actually, at least philosophically, is extremely simple. It's simply that in order to create a benchmark for a portfolio, what you should do is create a representative portfolio subject to the same constraints as your investments. So it's kind of worth focusing on a couple of the words in that definition. So the first is the word portfolio. And in a sense, actually, really, this is the sort of the main idea, to the extent there's any idea in this sort of simple idea here, which is that in order to benchmark, in order to create a benchmark, ultimately, maybe your interest is creating a benchmark return for inclusion in some report. But rather than going directly to that, what we want to do is actually first start by creating a portfolio benchmark. In other words, a benchmark that's actually a portfolio. Then the second word is constraints. So the idea here is that when commitments are being made, they're going to be subject to a variety of constraints. For example, maybe geography, maybe North American funds, perhaps by industry. And to the extent that there's a sort of a mandate, a target, or a set of constraints, they of course apply by definition to the portfolio, but they should also apply equally to the benchmark. Namely, the benchmark should be constructed in a sense to mirror those constraints. So for example, another example of a constraint might be based on fund size. So for instance, if for capacity reasons, we should avoid investing in small funds, then the benchmark should be subject to exactly the same constraint. For example, invest only in funds larger than 100 million, that same constraint should apply to the benchmark. A little bit more interesting are the bottom two bullets on this slide. So the first of those two says, commit 2/3 of capital to buyout and 1/3 to venture. So the idea is, if that is essentially a constraint under which you need to operate, then the benchmark should follow that as well. So what's interesting is that the point there is that that's in contrast to constructing a benchmark where you let the whims of the market, in some sense, dictate that ratio. In other words, each of those two asset classes have some capitalization, in particular in any sort of universe of funds that you'd use to construct a benchmark, they're absolutely going to have some natural ratio, But instead, what I'm saying here is it makes more sense to instead mirror the sort of the targets of your investment process. And then continuing with that theme is the last bullet point, commit equal amounts to every vintage. So in a sense, that's kind of very similar to the previous point, but maybe just a little bit more quantitative in that, again, any universe used to construct the benchmark is going to have capitalizations that vary vintage by vintage. And the point is that a natural thing in our view is rather than to let, again, the whims of the market dictate that, to instead construct the benchmark exactly mirroring whatever targets you have. So for the sake of argument, the targets might be, the simplest example would be to commit equal amounts every vintage. And if that's the case, then the benchmark should sort of mirror that as well. Okay, so let's do an example of this idea. So suppose that the mandate or the sort of the target is something simple like this. Beginning in 2008, we're to invest in US buyout, committing 10 million to each vintage year. So then given that mandate, we can do two things. The first is we can construct a benchmark portfolio, as I was saying. So this benchmark portfolio is shown in green. It goes vintage by vintage. In each vintage, beginning with 2008, it takes those $10 million and then it commits sort of uniformly, in some sense, to all the funds in that vintage in the universe. So in this case, the number of funds happens to be 69. So that $10 million would be distributed, would be committed in some sense uniformly across those funds. And then you continue in this way all the way down to 2017 and 2018, given the mandate, each time committing $10 million to sort of a broad set of funds. And the result of this is a sort of fairly large portfolio with many, many different commitments. And then one final point I'll make here, something that I'm brushing under the carpet, is when I said, for example, take the $10 million corresponding to 2008 and commit that uniformly across 69 funds in the universe, which, by the way, might be, for example, the Burgiss manager universe. What exactly do I mean by uniform? So there's at least two different versions of that. One would be literally equally commit to every one of those 69 funds. The other would be to commit in proportion to the capitalization of those funds. And that's also an interesting question, but for the time being, I'll sort of leave that aside. Okay, so given that mandate, then the obvious other place that it'll be implemented is in constructing your actual portfolio. So in this case, that's shown in the gray box. And again, it's a US buyout portfolio from 2008 to 2018. In this case, it commits to just one fund per vintage called Fund A down to Fund K. Okay, so now what we have is our portfolio, and then the benchmark, as I've now said a couple of times, is also a portfolio. Given our own portfolio, we may be interested in some particular measure, some particular statistic. For example, we might be interested in the most recent quarterly return, TWR, and of course, we can compute the analogous number for the benchmark portfolio very easily. But really the point, or one important point to note about constructing a benchmark portfolio is that any other number you want to construct, you want to compute for your portfolio, for example, a 5-year IRR can be just as equally computed for the benchmark portfolio. And indeed, it's not just limited to returns. If you wanted to compute some kind of multiple, like a PME, for example, or TVPI, that can be, of course, computed for the portfolio. And once again, the benchmark being a portfolio can also have that statistic computed. Okay, so in some sense, that approach is really fairly straightforward, aside maybe from the sort of the implied kind of data requirements of carrying out this approach. Maybe an interesting way to sort of kind of compare this is to sort of look at a slightly different approach to constructing a benchmark. So here the idea is that we're, instead of following this portfolio approach, what we're going to do is we're going to weight the returns of various subgroups that go into the benchmark. So the way this works is as follows. So the first is that, let's suppose that in fact, rather than being interested maybe in computing multiple statistics for a portfolio and the benchmark, we're going to focus on just one statistic, one measure, which here we'll just assume that it's a relatively short-term measure of return, such as a 1-quarter TWR. And then the idea is that we'd like to compute the benchmark return or the composite return in terms of the returns of the various subgroups that went into that portfolio. So suppose, for example, that the benchmark we want is exclusively just a buyout benchmark. And then let's suppose that the subgroups are just the separate vintages that we've committed to that go into that. So if you look at the example on the bottom of the slide, we're looking for the benchmark return, and we want to compute that number in terms of the returns of each of those subcomponents. In other words, the buyout return for 2008, which might be 2%, these are just illustrative numbers, etc., all the way down to the return for buyout in 2018. So, of course, you could take that list of returns, you could average it, but of course that would be nonsensical because the amount that you commit to different vintages might be different. For example, perhaps the amount you committed to 2009 was much less than the amount you committed to 2008. So needless to say, in order to construct the benchmark return, we need to weight those returns in some way. And we certainly would have to weight by the commitments. But a moment's thought would convince you that, of course, that's not enough either. Because, for example, the 2008 vintage at this point is almost completely liquidated. As a result, there's very little capital in the ground. Whatever return it exhibits should have very little effect on the top-level benchmark return. So a natural thing would be to weight not just by the commitment, but also by the NAV. In this case, what I've listed are, you could call them the unitized NAVs. In other words, the NAV of a hypothetical $1 commitment. Or another way of thinking that is that what we're going to weight by is the product of the commitment and the NAV, which you can think of as the commitment scaled NAV, the NAV of that commitment listed in the commitment column. In any case, once we're done with this, what we have is a set of weights, and these weights can then be used to compute a weighted return, which is the benchmark return. So again, one thing to note about this is that it's very much focused on just computing a return. If you ask some other question, like what the TVPI of the benchmark is, then it doesn't really follow from this kind of computation. And then the final point worth making here is that when I mentioned the NAVs, I didn't exactly say what they're the NAVs of. So in fact, the NAVs for this methodology are the NAVs that come from the benchmark, the NAVs of the corresponding groups in the benchmark. Okay, so this gives us a way of computing, for example, quarterly returns. We began with the portfolio approach, which is, as I said, what we consider to be the recommended approach. So the natural thing to do is to compare the quarterly returns that we get from these two different approaches. So let's look at a graph of that. So in this graph, what I've done is just for buyout, beginning in 1980, I've plotted along the horizontal axis the quarterly return computed using the portfolio-based approach, the recommended approach. And along the vertical axis, I've computed the analogous return, the 1-quarter return, using this return-weighted approach that we just described. And then the dotted line is the 45-degree line. In other words, it's the line where both numbers, representing both numbers being equal. So if both methodologies produced exactly the same returns, then all the dots, which represent each quarter of the data set, would be exactly on the 45-degree line, the dotted line. As you can see, in fact, most of them are fairly close to the 45-degree line. And what that shows is that this sort of second return weighting methodology is a sort of reasonable approximation to the sort of correct methodology. However, it's also worth noting that certainly not every dot is on the 45-degree line, and some of them are sort of fairly distant from the 45-degree line. In particular, there's at least 3 that kind of have got noticeable deviations, and in particular, at least one of them is a sort of a very large deviation from sort of the correct value. Another thing worth noting, actually, is that when there are deviations, particularly large deviations, they tend to be in the direction of the kind of the return-weighted approach, overestimating the benchmark return. And then finally, one final comment would be, which I touched on before, is having seen this picture, a natural question would be, well, why would anybody use the second methodology instead of the first methodology, given that occasionally it sort of produces these sort of problematic returns? And the answer, of course, is data. In other words, the advantage of the second methodology is that the input data is simply a list of the returns of the subgroups. And, well, that and also the NAVs of the subgroups. And given that, then you can construct the benchmark return. In contrast, the portfolio approach, in some sense, requires the complete data set, or else requires it to be done sort of in-house in some place like Burgiss, for example. Okay, so next let's look at the third and final methodology that I want to talk about. So in this case, it's going to be very similar to the previous methodology, but as I said, we needed to pick the NAVs from some particular source. In the second methodology, we used the benchmark NAVs. So this one is going to be essentially identical, except the source of the NAVs is going to be the actual portfolio. So there's a couple of reasons for doing this. One is actually, since we just talked about data, is that doing this sort of lessens further the data requirements, because instead of needing both the returns of the subgroups and the NAVs, now you just need, from an external source, you just need the subgroup returns, and then the NAVs come directly from your portfolio. Another reason is that it seems like using portfolio NAVs in some sense would align the benchmark better with your own portfolio. However, at least in our view, this approach is not a good idea, and there's a few reasons why we think this. So the first reason is essentially that it's philosophically wrong. In other words, what you're doing is you're entangling the benchmark with the portfolio, while in reality, the benchmark should be entirely decoupled from the portfolio. Of course, as I said, it should be still subject to the same constraints that the portfolio was, but it shouldn't be sort of adjusted in some way by the performance or whatever happens in the portfolio. Then the second reason is that if you do use portfolio NAVs, then you end up with a set of benchmark returns which are not replicable. So another word for replicable that could be used would be investable, but at least in this context, I think replicable is a better term. And all I mean by that is that in general, there will be no portfolio of commitments that can generate those returns, the portfolio weighted returns. And then finally, so there's a kind of a third kind of more down to earth perspective on why this is not such a good approach in our opinion. And essentially that is that it produces kind of, under certain circumstances, non-intuitive benchmark performance. So one way in which this can happen is that a very reasonable expectation is that the short-term and long-term performance of a benchmark should be in some sense kind of correlated. In other words, if a portfolio outperforms a benchmark consistently for many quarters, then over that sort of long period, using a long-term perspective, such as a long-term IRR, you'd also expect outperformance. Perhaps not absolutely all circumstances, but if you generated many random portfolios, in general, you'd expect that kind of correlation. So it turns out that if you do this kind of statistical analysis and you look at what happens when you use portfolio NAVs compared to the sort of the correct approach, then that kind of correlation is sort of diminished. And an even more down-to-earth perspective is that using it generates, at least occasionally, some rather peculiar or meaningless returns. Now, because of point number 2, you could actually argue that to some degree, all the returns it generates are, maybe to some small degree, not really meaningful. But what can happen is that at least occasionally, you'll get one return that clearly makes no sense and doesn't kind of follow kind of what happens in the market at large. So what we're going to do is we're going to look at that in a little bit more detail. Okay, so to do that, I need an example portfolio. So what I'm going to do is I'm going to use fund U.S. buyout funds. It's going to we're going to invest from 2008 to 2017, and we're actually going to commit equally to each of those vintages. Then the benchmark is going to be done essentially as we've described before. It's going to be investing equally kind of across all the funds in that vintage in our universe. And then our portfolio is going to invest in just one fund in each one of those vintages. Now, with the benefit of hindsight, we're going to choose that fund in such a way that its performance is very similar to the benchmark, right? So if this is all I said, you'd of course expect the portfolio to track the benchmark very closely. But we're going to do one kind of small deviation from this, and that's in one vintage, namely 2011, we're going to do something slightly different. In the case of the benchmark, we're going to simply follow the same pattern as before. We're just going to invest $10 million across all the funds in that vintage in the universe. In the case of the portfolio, we're again going to invest in one fund, and again it's going to be a fund whose performance is very similar to the benchmark. However, it's going to be a fund which you can think of as just doing things just a little bit sooner. In fact, what it's going to be is it's going to be very similar to the benchmark, but accelerated by 1 quarter. In other words, it's just going to call capital a little bit sooner, namely 1 quarter sooner. It's going to distribute 1 quarter sooner, and the NAVs are going to follow suit. But importantly, its performance is not going to be adjusted. It's still very similar to the benchmark. By the way, just in passing, notice that if you did have a portfolio with, for example, one fund in the 2011 vintage, you certainly wouldn't expect it to exactly track the timing of the benchmark. If you have just one fund, that fund might indeed be somewhat accelerated. Indeed, it might be accelerated by more than a quarter or delayed by more than a quarter, just kind of at random. So in any case, because that one fund is not any better or worse than the benchmark, I think you'd agree that sort of intuitively, this portfolio should still track the benchmark pretty closely. So what we're going to do is we're just going to look at the quarterly returns of the benchmark and the portfolio. And if you plot those, then, and in particular, we plot the benchmark computed sort of the recommended way, or in this case, it turns out that the recommended approach and the using the benchmark weights, which is the second approach, produce very, very similar numbers. We expect the benchmark and the portfolio to sort of agree very closely. And in this figure, I've shown the cumulative TWRs, quarterly returns, of the benchmark in green, in solid green, and then the portfolio is a dashed black line. And as you can see, it's a fairly dull graph. The portfolio indeed does track the benchmark very, very closely. In fact, it's not exactly identical to the benchmark, but the differences are so small that they're not really visible in this slide. So now let's look at what happens if instead of using the benchmark computed using benchmark weights, we use portfolio weights. So in that case, what happens is that actually it still tracks the portfolio fairly well, except for 1 quarter, which is the first quarter in 2011. And in that case, what happens is that while both the portfolio and the correct benchmark had a sort of a reasonable positive return, this sort of what we consider this alternative, this third methodology benchmark, has got a huge negative return, which really kind of jumps out in this picture. So clearly, and by the way, I'd like to stress that these are not illustrative numbers. These are actually real numbers from our database. So clearly, based on this, you should sort of be cautious about using the portfolio weight approach methodology. It's actually worth just kind of digging into what caused that negative return. It's actually pretty easy to explain. So what happened was this. The 2011 vintage initially had a fairly large negative return. However, that initial negative return in the first quarter was on very, very little capital. So the result of that was that when you incorporated into the benchmark using sort of either the first or second methodology, the one that effectively uses benchmark weights, it's kind of down-weighted very much, and it has very little effect on the benchmark, as one would expect. However, in the third methodology, where we use portfolio weights, what happens is that the portfolio happens to have a fund in that vintage, which, as we said, was kind of 1 quarter, did everything 1 quarter sooner. As a result, its NAV had grown enough that that 1 quarter negative return, which initially just kind of vanished, gets sort of multiplied by a large enough weight that it then comes to sort of dominate the benchmark and creates that sort of large benchmark negative return, which you can see on this graph. And then the final thing is, obviously, the red line doesn't represent what actually happened in the market. In other words, it's sort of an imaginary return that doesn't reflect any kind of large move in the buyout market. Okay, so that's all I'll say about portfolio benchmarking. Next, I want to talk about fund level benchmarking. So to set the scene, I'd like to just consider this small portfolio here. It's a portfolio of, again, 12 commitments to buyout real estate and venture funds, ranging in vintages from 2011 to 2014. And then these are actual commitments to actual funds. And then what I've shown is I've shown the rank of the fund we committed to within its peer group. In other words, within, in the case of, say, the top one, buyout 2014 funds. So whatever fund we committed to in this portfolio had a rank of 55%. So as you can see, if you look at the ranks, all the funds we committed to have ranks that are either at or above median. So I think you could say that while the portfolio perhaps is not stellar, it's also kind of not bad. In fact, just in passing, I'll mention that if these were flips of a coin, and you could either be in the top above median or below median with probability 50%, then achieving what this portfolio did, namely having 12 funds, all of which are above median, has a probability of occurring at random of less than 1 in 4,000. So perhaps not stellar, but in some ways it's not a sort of altogether bad portfolio. So we might think this is therefore sort of a reasonable portfolio. So now let's look at the since inception IRRs. So if you look at the since inception IRR of this portfolio, it turns out to be 15.5%. However, the corresponding benchmark IRR is 18%. So interestingly enough, while we, from a rank perspective, seem to have made sort of reasonable choices, from a since inception IRR perspective, this does not look quite as good. So let's look into what caused this. So one way to see this is to focus not on the ranks, but to instead look at the actual IRRs that are going on here. So what I've shown here is under the portfolio column, the IRR of the actual fund that we committed to. So for example, the first fund, the 2014 buyout fund, had an IRR of 16%. And then under the benchmark column, I've shown the benchmark IRR for that group, namely 2014 buyout funds. Notice that the benchmark IRR is what you could call a pooled IRR or a portfolio IRR. It's the result of forming a portfolio with all of that peer group and then computing the IRR of that large portfolio. And then the third column just illustrates the difference between the two, which as you can see is negative for every single fund. So in other words, from this kind of pooled perspective or sort of raw IRR perspective, we're underperforming every single time. And that ultimately is what drives, with a few sort of caveats, the difference in the two since inception IRRs that I listed. The reason for the discrepancy between the rank view and this kind of pooled view, the pooled is the benchmark column, remember, is kind of illustrated by this graph. So if you look at, essentially it boils down to the fact that for many vintages and many sort of subclasses, but actually particularly for venture capital, the distribution, the histogram of IRRs is a skewed histogram. In other words, it's kind of not symmetric, but sort of has a tail to the right. So in this case, what you can see is that the median, which is in blue, is actually around 0. In contrast, the mean return, which is in green, is actually significantly greater than 0. So for example, and the reason for that, by the way, is that there's kind of a reasonable number of funds that had spectacular returns over to the right, some of them over 150%. So if your fund, if a particular fund you're interested in, let's show its IRR as the dotted line, if that fund's IRR were compared to the median, then it would look quite rosy. On the other hand, if you compared it to the mean, then it's not looking so good. And then finally, I'll just mention that while the mean return is not quite the same as the pooled return, for the purpose of this presentation, they're reasonably similar. Okay, so now here we saw, basically in summary, why sort of the reason why mean or pooled returns end up kind of overperforming the kind of the median perspective. So given that, what should we do about these ranks? As we've seen, they can be to some degree deceptive. So certainly one possibility is to say that we should ignore them and focus only on looking at the sort of the pooled benchmark, comparing the IRR of the fund we committed to with sort of the pooled benchmark IRR. But we feel that this is a bit extreme, that it's throwing the baby out with the bathwater. And the reason for that is that ranks actually do say something quite useful. And essentially what they directly answer is they give you a measure of if you outperform a peer group by how much you outperform. So for example, if the fund that you commit to is a top quartile rank, then literally by definition, it says that the probability of doing that at random is only a quarter. So we'd like to preserve that intuition. And it turns out that it is possible if what we do is we compute not just fund ranks, but also portfolio ranks. So let's look at that. So let's start by first just reproducing the data that I showed back a few slides. So here we can see the portfolio of commitments of the dozen commitments we have. On the right, you can see the ranks. As you can see, they're all at or above median. Then what started this conversation was that we started looking at the since inception IRR, and it turned out that the benchmark was 18%, the portfolio was 15.5%, call it 16%. So we underperformed by a significant amount the benchmark. While we're here, I'll just mention that in addition to computing the sort of the top level since inception IRRs, we could equally compute the since inception IRRs of each subgroup, namely buyout, real estate, and venture. So I'll include them in this table as well. And then finally, we kind of explained the discrepancy between the sort of since inception IRR for the entire portfolio and the fund ranks by looking at the IRRs of each of those funds we committed to, and then the mean, or more precisely, the pooled returns of the corresponding peer group. And there we saw that in every case, we underperformed, right? So now we go back to the ranks and sort of say, well, what could we do to sort of maybe recover some of the intuition or sort of get over this sort of discrepancy that we're seeing? Well, the source of the discrepancy was this difference between medians and means, which you can attribute to the fact that the pooled IRRs that are listed below are sort of like means, or they're pooled numbers. They incorporate a portfolio effect, while the ranks on the rightmost column are purely kind of median focused. They're just one-on-one. There's no portfolios being formed at all. So one thing we might say is, well, let's try to mirror that. Let's try to look at some portfolio ranks, right? So for example, we might try to compute some kind of rank for just a sub-portfolio of our portfolio consisting of buyout funds. So what would that mean? Well, in some sense, it should mean this. Our portfolio has 4 commitments to 4 funds. And what we want to do is we want to rank that portfolio of 4 funds in the set of all portfolios of 4 funds that are buyout funds in those vintages. So while literally doing that would require comparing our portfolio to tens of millions of different portfolios, a simple thing to do is just randomly generate thousands of such portfolios, namely portfolios with commitments to 2014 to 2010 buyout funds, and then rank our portfolio amongst those. So if we do that, we get a rank for our portfolio of 48%. And what's interesting about that is that this is now looking as a rank a little bit more in line with what we saw with the since inception numbers. In other words, while the individual funds were all above or at median, now from a portfolio perspective, we see that we're below median, and this is because of this kind of portfolio effect. So of course, we can repeat that exercise for real estate and venture, and we get some numbers there. Obviously, real estate turns out to be even more extreme. It's kind of almost in the bottom third as a portfolio. And then, aside from doing it for each subgroup, we can do it at the top level, and we get a top level rank for our entire portfolio. So in some sense, that top level number, 35%, says amongst all similar portfolios to our portfolio, where does our portfolio rank? And kind of in terms of what I said before, the sort of the directly answering sort of the difficulty or not of what we did, what this says is that 2/3 of random portfolios would have outperformed our portfolio from an IRR, a since inception IRR perspective. And then one final thing I'll say about this is that because the benchmark is a portfolio, we're not limited to any particular statistic. So we could have done this for the most recent quarterly return. We've done it, in fact, for since inception IRRs, but we could also do it, for example, for TVPIs, which is on this slide. So we just generate exactly the same report for TVPIs. Now, the main point I want to make here is just that because we use a portfolio approach for everything, essentially every statistic we want can be generated exactly in the same systematic way in exactly the same kind of format report. But as it happens, this TVPI report has one interesting sort of data point inside it, which is just worth dwelling on for a moment. So at the top level, the TVPI report says something vaguely similar to the previous IRR perspective. In other words, if you look at what I call the active column, which is simply the difference of the benchmark and the portfolio IRRs, whether or not subtracting them is a sensible thing to do doesn't really matter. But just to keep things identical from the previous report to this report, I just subtracted the two. So as you can see at the top level, that active number is negative, indicating that we underperform from a TVPI perspective. And indeed, the rank is below 50%, which kind of is in line with that. However, not all of the portfolio looks like that. If you scan down to real estate, it turns out that real estate is actually quite different. So if you remember on the previous slide, real estate from an IRR perspective was actually quite poor. I think it was maybe 38% or so as a rank. From a TVPI perspective, it outperformed, both in terms of the active column and also in terms of the rank, which is 77%. So from a TVPI perspective, the real estate sub-portfolio seems to be top quartile. So at first you might say, well, is that an error? I mean, does that seem to contradict the IRR perspective? And I think what's interesting is that, in fact, it doesn't. It's what we would call essentially an endurance or a duration effect. And it is absolutely an effect that is seen from time to time. But the purpose here is not so much to sort of dive into this particular portfolio, which ultimately is a sort of mostly random portfolio, but just to illustrate that A, we can easily generate multiple perspectives, IRR, TVPI, or any other statistic, and that these multiple perspectives, I think, give some interesting insight as to what's going on. So finally, in conclusion, I just want to reiterate that in our view, there really is a correct way to construct a benchmark, which is focused on creating a suitable portfolio. There are numerous other methodologies out there. Some of them are approximations to the correct approach, and others have sort of some more sort of interesting issues with them. Then the second point is that fund ranks are sort of useful, but they can sometimes be somewhat misleading due to the skewed nature of the distribution of return, but that these problems can be ameliorated by, or we can improve our intuition by looking at portfolio ranks. Then the next point was that this kind of perspective can be done not just for returns or IRRs, but for any statistics such as TVPIs or PMEs or even endurances or any statistic that can be computed on a portfolio. And then finally, as we saw in the last two tables, which we can think of as a report, these are reports that can be sort of generated. They're very systematic. They're naturally hierarchical. They codify all the best practices, in our view, on how these numbers should be computed, and can easily include multiple perspectives on the portfolio. In other words, not just a return or whatever measure we're looking at, but also a rank, not just IRR, but TVPI or any number. And then finally, I'll just mention that, of course, these reports are not trivial to generate, and this is something that Burgiss is kind of actively thinking about at the moment. So I think that's it.
Well, thank you, Luis. That's a lot of information there and a lot to digest. Thank you for that. As I mentioned, everybody on the phone, when we started, we've been taking some questions throughout the webinar. And so we'll take a few minutes here before we wrap up to have Luis respond to a couple of those.
Okay.
With that, Luis.
Okay, thank you, Chris. Okay, so let me start with one which I think is fairly quick. Why does the benchmark NAV weighting approach occasionally exhibit large deviations from the portfolio-based approach? So the idea there, I think, is that if I go way back to this slide, I just casually mentioned that there were a number of outliers when you computed using the return weighting approach, but I didn't explain what caused the outliers. So it turns out that essentially what tends to push the second approach, the return weighting approach, away from the correct approach is the presence of large cash flows. It's a little bit more complex than that, but loosely, when in a particular quarter the return is dominated by, for example, large distributions, then the second approach tends to sort of deviate from the correct portfolio-based approach. So essentially, those particularly large, those three large outliers were simply quarters where there were very large kind of outflows, most likely, in our universe. Then maybe the next question. Does the Burgiss platform allow users to create a portfolio-based benchmarks? It'd be interesting to have detailed information on the benchmark. Okay, so yeah, this is actually an interesting point. Right now, the portfolio-based approach is not something that can realistically be done on our platform. But as I said, this is actually something that we've been thinking about, and we feel that it's something that we're working on it. We'd like to do something in this direction. We certainly would like to be able to generate the kind of reports that I mentioned, that I showed at the end of the presentation. And certainly, if you have any sort of interest in this or feedback, we would be more than happy to receive it. And then maybe, do we have time for one more question, or should we wrap up?
Yeah, one more.
Okay.
Yeah.
So then, maybe the final question I'll answer is wouldn't the portfolio-based approach, by assuming that such a portfolio has unlimited resources and access to all funds, have an undue diversification advantage? Okay, so I think there's maybe two words that I'm picking up there. One is the word access, and then there's diversification. So in terms of access, I think it is true that whenever you're benchmarking, access is always going to be an issue. And I think that nothing I've said here really changes any of that. But then turning over to the diversification question, what I would say is this. The diversification is an important issue when it comes to benchmark. It's important to stress that it doesn't really affect sort of the average or the expected returns of the benchmark, but it certainly does have an effect on sort of the risk profile of the benchmark, because of course, investing in a large portfolio is going to diversify away sort of any idiosyncratic risks that are present. And maybe I'll stop there, Chris.
Yeah, no, thank you, Luis. And apologies, everybody on the phone. If we weren't able to get to your questions today, we will take time, and our research team will respond via email. And of course, please feel free to reach out to support or your local client coverage representative, and we can answer any questions you have there. Thank you, everybody, for participating. I would like to let everybody know we're also doing another installment of this webinar this afternoon at 2 p.m. So if you have any other colleagues or others that weren't able to attend, please feel free to send them that invitation, and we'll look forward to speaking to them then. And then with that, on behalf of everybody here at Burgiss, and thank you, Luis, I thank everybody for attending.